Welcome to the Citizens Monetary Policy Committee meeting. The global events may change things dramatically for the Reserve Bank and for its Monetary Policy Committee, which announces its decision on Thursday. Whereas during the June policy, the Fed was expected to cut rates by just 25 basis points once in 2024. Now the markets are expecting a 125 basis point cut in 2024 itself. So what should Reserve Bank and its MPC do? As always, CNBC-TV18 Citizens Monetary Policy Committee meets to give us an idea of the issues before the RBI. I have with me Chairman of our committee, Dr. Pranab Sen, and members Shyamikanti Ghosh of SBI, Sajid Chenoy of JP Morgan, Shamiran Chakraborty of Citi, and Sonal Verma of Nomura. Gentlemen and Sonal, thank you very much indeed for joining us. Sajid, first delineate the global scenario for us. Will it not be a pressure on the RBI and MPC?
Latha, good morning. I think this is the biggest change between the last monetary policy meeting and this one. You know, we've been making the case for global resilience for the last 2 years now. The global economy has been remarkably resilient. But that resilience was predicated on two phenomena. One, that the US exceptionalism would fade and Europe would start carrying its own. And the second was that even as the services sector slowed, that manufacturing would recover and you'd get some kind of goods recovery. Both those hypotheses have been severely challenged over the last few weeks. We've seen very disappointing PMIs mid-year. If you take it literally, the global output goods index is down by 2.5 points, which means essentially global factory output has come to a stall, A. B, we've seen Europe has disappointed. So the US is the only growth engine. China has been disappointing. But I think most importantly was the crack in the labor market that we saw last week. I think what we're seeing now is that this is the fourth consecutive increase in US unemployment, and the SARM rule, so to speak, has been triggered, where the unemployment rate is now almost a percentage point, 0.9 percentage points higher than the cycle low.
Yes.
We also had last week, for the first time, only 49.6% of US businesses increase headcount. This number has only been below 50% once when you're outside of a recession. So there are ominous signs now that the global economy is not getting the resilience from manufacturing and from Europe. And that you're seeing cracks in the US labor market. It's too early to say that we're in the midst of a recession. This is only 1 or 2 data points. And remember, we had Hurricane Beryl, which may contaminate the last data. But no matter how you cut it, this is a worrying slowing of global momentum. And even if we avoid a US recession, given where the labor market is, given the slowing in the last few months, given how wages have slowed, given how core inflation has slowed, the Fed is offside by at least 100 basis points. So even if you don't get a recession, our sense is both in September and November, you get a 50 basis point cut. In fact, I think there's a strong case to be made from a risk management perspective that the Fed possibly even cut before the September meeting and not wait for things, because recessions are very non-linear and you don't want to be caught on the wrong side of this non-linearity.
Fair point. That's the market expectations for you running on the screen. 125 basis and 50 basis September can be advanced is what Sajid is saying. Sonal, there is in addition a Chinese deflationary impact, which is perhaps already showing up for us in terms of low core CPI in India. You tell us, will the RBI need to change its inflation and growth forecasts already?
No, Latha. I mean, we think they'll maintain 4.5 on CPI and 7.2 on GDP. I think we did get an upside surprise on food, particularly vegetable prices, which means that the second quarter CPI forecast of the RBI, which is currently at 3.8, will need to get revised higher a shade. But since this is driven by vegetable prices, which tend to mean revert, and the positive progress on monsoons, which actually bodes well for the broader food basket, we think there'll be an undershoot on food as well as headline inflation in the second half of FY25. So very much on track despite the upside on vegetables and the expected pickup in telecom. I think most importantly, Latha, I think the RBI's concern has been that inflation is not aligning to the 4% target. Our view is inflation is already aligned to the 4% target. core, all measures of underlying inflation have been sub 4% for quite some time. And given the crack we are seeing in global commodity prices, it means that the increase we had seen in commodity price pressures is going to reverse going forward. And as Sajid said, there's downside risk growing to US growth and therefore over time to India as well from a growth perspective. So no change as of now in terms of FY25 numbers, but downside risk to growth as well as to inflation over time, I think, have increased.
Okay. Well, there is another problem as well, the fight for deposits. Soumya, let me come to you with that. With the new LCR, liquidity coverage rules, the fight for deposits could get worse. Should the Reserve Bank think of a CRR cut even before a repo rate cut?
I think that's a very valid point because issue with the deposits is now becoming more of a structural one. As you know that there in the budget also there has been some adjustment on the tax treatment across different asset classes. The most important point regarding the fact that the deposits are not growing. Deposits are growing, but not to the extent which credit is growing. For example, this year, even after last year, the deposit growth was 13.5%, which is a very healthy amount. This year, the incremental deposit growth has rupees 7 trillion as against 10 trillion last year, which is still a very healthy growth, but not as much even if you look into the aspect that the deposit rates were hiked by several banks. The problem with the deposits, and I rightly pointed out LCR, is that deposit rates are unlikely to come off in a jiffy anytime now, because as long as you don't have a treatment of the deposits of uniform across all asset classes, I think it will be very difficult for the deposits to pick pace with the credit. And to your question of this CRR, I think that's a valid question because at the end of the day, as you know now, liquidity is now managed more on a real-time basis. We have been included in the bond index, so that makes the capital inflows also very volatile. That also makes and as you know that the government cash balances now is a very important factor in the entire scheme of things, given the fact that government has moved into the JIP. That means that fund balances also will remain a constraining factor in freeing up liquidity for the banking system. So my sense is that it may be a good idea, and we have discussed this earlier also, that to make CRR and LCR as a cyclical to manage liquidity over a point of time, because in my sense, even if in hypothetically for the central bank wants to cut rates at some point of time in the future, it will be it may not give us still a signal that repo rates and lending rates will come down from the current levels.
Fair point. You know, we are getting carried away, Samiran, by the way in which there was a meltdown after the Friday jobs data. But otherwise, the financial conditions were actually described as loose. We had the SEBI chairman, we had the RBI governor, everybody speaking about, there's F&O and, financial worries about financial stability. So can you develop on what Soumya is saying and how the MPC and RBI may approach financial conditions?
So Latha, first to start with, the crude indicator that everyone tracks is the banking system liquidity. And in banking system liquidity, we'll see that durable liquidity is now more than 4 lakh crores. And even the system liquidity, the frictional liquidity, the last print has been 2.7 lakh crores. So clearly, liquidity is in that sense ample in the system. And if you extend it further to a more broader financial conditions index, which will capture not just this liquidity, but also the short-term and long-term rates, the FX markets, the equity markets, the credit markets, everything. In fact, what shows up clearly in that index is that it tightened a little bit around April, May, but from there on, it has loosened up again till now. And then all through the while, I would say that by our understanding, these financial conditions have remained somewhat easy rather than tight. So in that sense, it is possible that the RBI can keep their stance as well as their policy rate unchanged for a longer time without being worried of the fact that they have over-tightened the system. And I think that's a very important thing to keep in mind, that we should not just be looking at the repo rate in isolation, but look at it in the overall context of where the financial conditions are.
Oh, absolutely. The liquidity, if you count what is with the government, 4 lakh crore. So where is the argument for a CRR cut? It's probably even for a hike. But Dr. Sen, the other big point which the Reserve Bank has to consider is the fiscal deficit, which has come down more dramatically than the Reserve Bank would have contemplated even in even in the June policy. So putting that and the other lead indicators we have of growth, what do you think the MPC should do? Remember, 2 people have already been asking that there should have been cuts already.
Well, Latha, it's not just what's happening to the fiscal deficit. What is important is that what the budget signifies is the overall fiscal stance. What the government considers important, what it doesn't, and what the macro dynamics arising from that are likely to be. Now, if you look at it in those terms, the way the budget has worked out, yes, you've got the fiscal deficit coming off much more than had been targeted, and most people hadn't even expected this. But much more importantly is the way the government has actually played around with the expenditure side of the budget.
Yeah.
And the expenditure side of the budget tends to suggest that if one looks at it a little carefully, the pace at which government expenditures will move will be higher than what we had last year.
Yes.
And that is the important thing. So there is, as far as monetary policy is concerned, you have a situation where the government draws on its balances. It's going to be large. Which you will have to keep an eye on. Now, this is a short-term thing. It evens out over the course of the year. But the point is that everything depends upon how the pattern of government expenditure correlates with the cycle.
Fair point, sir.
And that is something we need to keep our eyes on. And the RBI will certainly need to keep its eyes on that.
Fair point, sir. So liquidity, that adds, if the government is going to spend very quickly, that will already ease. So need the MPC or the Reserve Bank do anything? That question after the break to my experts. Also, there is a neutral rate which the Reserve Bank has kind of put on the table. All those questions after the break to the members of the Citizens Monetary Policy Committee. Welcome back to the deliberations of the CNBC-TV18 Citizens Monetary Policy Committee. I've been speaking with the chairman of our committee, Dr. Sen, and members Samiran Chakrabarti, Sajid Chinoy, Shaumikanti Ghosh, and Sonal Verma. Gentlemen and Sonal, thank you very much for your patience. Shamiran, I spoke about the neutral rate. Now, just for our viewers, the real rate is the difference between inflation and the repo rate. At the moment, repo rate is 6.5%, and the inflation for the current year is forecast at 4.5%. Now, Reserve Bank's latest July bulletin says that the neutral rate, that is the correct difference between the two, the ideal difference, should be 1.4 to 1.9 percentage points. So, Samiran, how much will this play in the discussions?
So, Latha, as you can understand that the neutral rate is a theoretical construct, and then determining that requires a lot of assumptions and modeling. In fact, the number that RBI has put up of 140 to 190 basis points of neutral rate in itself depends on which model they were using. But the main conclusion seems to be that the neutral rates are now reverted to where they were, let's say, somewhere around 2015-16. So to that extent, the COVID-related distortion of neutral rates falling a lot, that probably has gone out of the way, which gives the RBI, which will give the RBI some comfort in deciding their overall policy. Having said that, the policy decision in itself is not a mechanical one. where you just
Yeah.
align your rates to the neutral rate. In fact, neutral rate is, as the governor has mentioned, is not the target for the MPC. The target for the MPC is to meet the 4% headline inflation over the medium term. So
Yeah.
I think they will have to calibrate their policy rate in a way that it does not get too much off from the neutral rate, but at the same time keeps the economy aligned towards that 4% medium term
Yep.
CPI target. The problem in India also is that, in theory, the real rates should be measured with respect to expected inflation 9 to 12 months ahead. But given the repeated supply side shocks that we have seen, it's much harder to make that 9 to 12 month ahead forecast. So there is willy-nilly a possibility that the RBI will look at some kind of an average inflation rate to determine where the real rate is compared to where the neutral rate is. I don't think they are very misaligned at this point of time.
Oh, right. Okay, but we will at least get to hear a little more from the press conference. Sajid, yeah, this, aligning the target to the inflation rate of 4%, do you expect any changes in their forecasts, or at least a downside, a possible downside surprise, considering that, situation has changed globally? So are you even advancing the chances of a cut?
Yeah. I think, Latha, it's a little premature to discuss that as yet, because I think that even though downside risk may have increased for the reasons that Sonal mentioned, if global growth slows discernibly, global commodity prices will slow, and that's going to have a further disinflationary impact on the goods sector. But the fact is, food inflation has been the elephant in the room, so to speak. Food is 46% of the basket, and food inflation has averaged 8% over the last year, thereby nullifying all the disinflation from core. Now, the good news is that at the margin, the monsoon has progressed better, though it's spatially extremely uneven. But there's a little bit more conviction now that the food price spike that we saw, which was largely vegetables in the last few weeks, has begun to stabilize and reverse. And hopefully in the months to come, you will get more sustained food disinflation. But it's a little bit premature sitting in the first week of August to make those judgments. So my sense is that till there isn't more evidence that food inflation is going to get off this 8% trajectory and settle more durably at a much lower number, such that the RBI has conviction that at least we're in the 4% handle, headline CPIs and the 4% handle, it's a little too early. So while I expect that there'll be downside risks flagged from what's happening globally, my suspicion is that we won't get material changes in the baseline forecast. Maybe you'll get intertemporal changes. One quarter moves up, one quarter moves down, but nothing fundamental. Though this does set up the situation nicely for the next quarter, where if food inflation settles down, the monsoon has progressed nicely, and you're getting global disinflation, then you have much more confidence that you can act in monetary policy in the months to come.
Okay, then Soumya, see, there is this global meltdown, Chinese disinflation, better than expected progress of the monsoon. Even if there is no advancing of the cut, the Fed is clearly likely to, but even if the RBI doesn't advance its cut, is it time to think about change in the stance? Do you expect that, some indication in the upcoming policy?
See, I think, Latha, honestly, I believe that the change in stance and the rate cut should not have large interregnum in terms of the distance. Ideally, they should happen simultaneously. The simple reason is that if you change the stance early, and then if you go for a rate change, whatever is the change, that means that you are allowing the markets to front load you. Yes. I think that's one point which the Reserve Bank of India would like to avoid. So ideally, it could go ahead with the change in stance and a rate cut whenever it feels it is appropriate to do so. And also the fact that regarding the Fed, I think that US job markets now looks to be a little worse than it was earlier. And if you look from April 23 till June 2024, the downward revision in the payroll data, which I think we may have missed out, is around 5 lakhs. So that's not a small number. And yesterday's the number which came out on Friday has also been very weak. But there is also the consensus that elections are due in November. So the Fed may have to do a balancing act. But the chances of a rate cut in September looks bright. But for me, the Reserve Bank will need to look into the inflation trajectory, because as of now, the Reserve Bank projection of 4.5% may be an underestimate given the current volatility in food prices.
Oh my God, underestimate, you think? I was expecting you all to say the other way. But Sonal, is there going to be a tussle in the MPC meetings about whether the Reserve Bank should change its stance now? Do you think it would change its stance now?
Absolutely, Latha. I mean, we've been seeing that for quite some time, and I think it will continue. My own view is the MPC should change the stance. Primarily because, what is the role of the stance otherwise? What's the relevance of this stance? I mean, the stance is supposed to indicate whether the next move is a hike, a pause, or a cut. Given local and global developments, I think hike can be ruled out. So if the next move is a pause or a cut, then I think that makes sense to actually move the stance in light of that. And I think, we've been talking about upside risk to food inflation, upside risk from geopolitical, and therefore all of that spilling over. We have not seen that for the last 12 to 18 months. As I mentioned, all measures of core are actually running closer to 3%. Rural wages, urban wages, inflation expectations remain very well contained. So we can worry about, some of these risks. But I think even ex-vegetable, which is the most volatile component of the food basket, CPI ex-vegetables is also running at 3.5%. So the point of, inflation is aligning or not to the 4% target. I think that assessment has to be made in that broader context rather than just focusing on where headline inflation is today. So we see headline inflation actually converging closer to the target. I think underlying metrics already show it's closer to the target. High frequency India data in terms of MHCV sales, passenger vehicle sales show there is a softness. Global demand seems to be probably not as strong as we think, and the global central bank cycle is turning. So, therefore, in my view, we should change. Whether they change or not, is the point of, will markets run ahead? But then markets look at data, markets look at what global central banks are doing. And, if the MPC does not change the stance, as I said, it completely loses its relevance.
Okay. Well, Dr. Sen, if you could, round it all up, maybe the Reserve Bank and the MPC don't do anything. I mean, they don't change the stance and they don't change their action. But is there a need to at least indicate some softness in some other fashion?
Look, let's be very clear. And I completely agree with Sonal on this. The stance is something that should precede any real step that is taken. That's the whole idea of the stance. To be able to give the market an indication of how they should be thinking. If you do the change in stance and the change in the rate simultaneously, you might as well get rid of the stance. I mean, it makes no sense. So the stance should proceed unless there is such a high degree of uncertainty that you don't want to do any change. I don't think we are there. There is global uncertainty, but if you look at the domestic conditions, things are not that bad at all. The only problem, again, coming back to vegetable prices, is that, all the other metrics of inflation are fine. It's only vegetable prices. But if you have been watching what has been happening in the parliament over the last week or so, vegetable prices have become a huge issue, right? And the government is, I think, under pressure to be seen to be doing something about it. At the moment, growth is not under discussion. I mean, nobody is raising it as an issue. But vegetable prices are. So there is a pressure on the government. Whether that will affect the decision of the MPC, I don't know. I hope not. But that pressure will certainly be there.
Oh, right. So that will play on their minds. Okay, let's invite our MPC members to vote. Obviously, the first question, all of you, please take up your pens or your electronic buttons. First to you, Shaumya, what will the MPC do to rates on Thursday? Shaumya.
I think the MPC will continue to hold the rates.
Okay. Sajid,
Hold.
hold. Samiran,
It's a hold.
Sonal,
A pause.
okay. Dr. Sen,
Hold.
okay, that's a unanimous vote. Now let's come to the stance where I have heard some different arguments. Will the MPC change its withdrawal of accommodation stance in this policy? Shaumyo.
I think the stance will also remain same, withdrawal of accommodation.
Okay. Sajid?
I believe for now they will retain the stance.
Okay.
Withdrawal accommodation.
Okay. Samiran?
Retain the withdrawal of accommodation stance.
Sonal?
They should change,
Should.
but they will likely retain.
Okay.
Yes.
Should. So I'm taking you as neutral. Dr. Sen?
I agree completely. They should change, but they are likely to retain.
Okay, so I will take it as two neutral votes, and who knows, that might be the surprise in this policy. Very quickly, a third question. When do you see the first rate cut? Shaumyo?
Maybe possibly the first rate cut could come in December 2024.
Sajid?
The October to December quarter.
Okay, so
Given
it
global developments.
could be as early as October then. Samiran?
We are calling for April 2025.
Oh, okay, unchanged you remain. Sonal?
October.
October, that's I think two people are getting it a little forward. Dr. Sen?
Uh,
Okay.
December or early next year.
Okay, early next year. I'll take it as 2024. But even then, it clearly looks like there has been a slight advancement of the rate cut expectations by our committee. But the most important thing is there are two people saying that the RBI should go for neutral. Let's see whether they spring a surprise. Wrap up on this edition of the Citizens Monetary Policy Committee. Thank you very much, members.